Today, we're going to discuss why Bond B is expected to trade at a higher price in the market compared to Bond A. Here's the breakdown. Bond B has a shorter maturity period, which inherently means it carries lower interest rate risk compared to Bond A. According to research by PIMCO in 2024, longer-term bonds like Bond A face higher uncertainty and are more susceptible to fluctuations in interest rates. Investors generally favor bonds with shorter maturities due to their lower risk profile. This presence, this preference leads to higher demand for Bond B. Because investors demand lower yields for short maturity bonds like Bond B, its price increases. Lower yields indicate higher bond prices. As a result, Bond B commands a higher market price relative to Bond A, as noted by PIMCO's analysis. In summary, Bond B's shorter maturity, lower interest rate risk, and preference among investors for lower yield securities contribute to its higher market price compared to Bond A. Understanding these dynamics is crucial for assessing bond market movements and investor behavior. In considering the impact of rising interest rates on bond prices, it's evident that Bond A and Bond B will see decreases in market prices. However, the extent of the price drop differs between the two. Bond A, with its higher interest rate and greater sensitivity to interest rate changes, experiences a more pronounced decline. Conversely, Bond B, having a shorter time to maturity, suffers a less severe decrease in price, as noted by Ludis in 2024. The longer duration of Bond A exacerbates the effect of rising interest rates on its price. Understanding these dynamics is crucial for investors as they navigate bond markets. They need to anticipate how different bonds will react to changes in interest rates to make informed investment decisions. So what's the rationale behind it? Understanding the rationale is important. When interest rates increase, bond prices generally fall, as higher interest rates makes existing bonds less attractive compared to new issues with better yields. Bond prices are directly influenced by changes in interest rates. Higher rates lead to lower bond prices, while lower rates tend to increase bond prices, reflecting investor yield preferences. Schwab's research in 2023 emphasizes that the relationship between interest rates and bond prices depends significantly on the duration and maturity of the bond. Bonds with longer maturities typically have higher durations, making them more sensitive to interest rate changes and resulting in more significant price fluctuations. Understanding these dynamics helps investors anticipate how their bond investments will respond to changes in interest rates, enabling them to adjust their portfolios strategically to manage risk and optimize returns. It underscores the importance of considering duration and maturity when making bond investment decisions. So bonds with shorter maturities, such as a 5-year bond term of Bond B, display less sensitivity to interest rate changes. Shorter duration implies decreased sensitivity, resulting in lower price volatility. Short-term bonds like Bond B demonstrate steadier reactions to shifts in interest rates compared to longer-term bonds. Understanding these characteristics is crucial for investors as short-term bonds offer more stability in response to interest rate movements. This stability can be advantageous for investors looking to minimize price fluctuations and maintain steadier returns in their portfolios, particularly in environments where interest rates are ever-changing. In considering which bond would have a higher percentage price change if interest rates increase, we look at Bond A, with a 30-year maturity, is more sensitive to changes in interest rates due to its longer term. Longer durations like Bond A amplify price changes by interest rate changes. This is because they have a longer time frame over which future cash flows are received, making them more susceptible to changes in discount rates. Therefore, even a small increase in interest rates can lead to a larger percentage decrease in price for Bond A compared to Bond B. Understanding this relationship between duration and price sensitivity is essential for investors to gauge for potential impact of interest rates changes on their bond investments. It highlights the importance of considering bond duration when assessing risk and making investment decisions, particularly in anticipation of interest rate fluctuations. Continuing our exploration of the impact of rising interest rates on bond prices, Rising interest rates typically result in falling bond prices, as a well-established phenomenon in bond markets. Longer-term bonds tend to experience more significant price declines when interest rates increase, as highlighted by Fidelity in 2024. Historical data confirms that longer-term bonds have heightened sensitivity to rising rates, leading to larger price declines. In the provided numerical example, bond A, with 30 years to maturity, initially priced at $1,210.22, dropping to $1,099 and 83 cents when the interest rate increased by 1%. Conversely, bond B with 5 years to maturity starts at 1,579 and 90 cents and falls to 1,426 and 97 cents with the same 1% interest rate increase. The significant price drop for bond A compared to bond B demonstrates the higher sensitivity of longer-term bonds to interest rate changes. Bond prices move inversely to interest rates, and longer maturity bonds experience more substantial price fluctuations. This example highlights the impact of duration. The longer the time to maturity, the greater the price change for a given change in interest rates. Investors need to consider duration of risk when making investment decisions, particularly in anticipation of interest rate movements. And finally, the investment strategy. In the current economic scenario of an anticipated slowdown, adjusting the investment strategy involves increasing allocation to government bonds, particularly in bond A. With the possibility of the government reducing interest rates to stimulate the economy, longer-term bonds like bond A become more attractive. Bond A's longer maturity makes it highly sensitive to interest rate changes, and its price is expected to increase significantly if rates decline. Therefore, allocating more funds to bond A can capitalize on potential price appreciation resulting from rate cuts during economic slowdown.